Studies show that the more you trade, the worse you do. Today, we're exploring psychological reasons why humans make bad stock market traders and how you can do better. What if I told you that the biggest threat to your investment portfolio isn't the stock market, it's you? Hey, friend, and welcome to the Lawyer Millionaire Podcast. I'm excited that you are here today, and I'm here with you in the studio. So come on into the studio and let's have a chat about stock market investing. You know, this is kind of the culminating topic almost of our current book club read this quarter in the Lawyer Millionaire Masterclass book club. We're reading A Random Walk Down Wall Street. And if you haven't been following along with us, don't worry, it's not too late. Go grab your copy. This is really one of the best books on investing that money can buy. I lie not to you. So we've been taking some lessons from here this quarter and talking about it in our book club, which, by the way, if you're not a member of the Masterclass book club yet, you owe it to yourself to join. It's a great time. We have a great community of over 100 law firm owners, and you'll get to read some incredible books and connect with some really, really incredible people and grow your network. Become a better business leader, grow your revenue, all of that. So check out the show notes for the link. Today we're talking about behavioral finance. What is behavioral finance? Well, you know, people are not as rational as economists assume. Now, you may recall, if you've been listening to the show on a previous episode in this, along with this book, you know, we talked about the efficient market hypothesis. The efficient market hypothesis says that it's not possible to consistently outperform the market or to pick winning stocks or pick stocks that are undervalued and experience a gain on the market ahead of the crowd because markets are efficient. And what that means is that you can't find mispricings. You can't find stocks that are undervalued in hopes of them becoming overvalued. Maybe you once could when stock markets were less efficient, but today stock markets are highly efficient. It's impossible to take advantage of information, of patterns, of all kinds of different things to gain an edge. But we also talked about the biggest bubbles in history. We talked about Wall Street. We talked about in the 1920s how stock prices were, going higher, irrationally high, way, way out of line with any kind of rational valuation, and to the point where they eventually crashed and burned, and you had the Great Depression and all of that ensued. And that was not a one-time thing. That, history is littered with examples. The dot-com bubble and the mortgage housing crisis and the meme stocks over and over and over again. There's always a bubble somewhere. So how do we reconcile these things? How do we reconcile the fact that markets are efficient and yet they are highly irrational at times? Behavioral finance theorists believe that market prices are highly imprecise. In other words, they're always incorrect. However, it's impossible to know in the moment whether stock prices are too high or too low. And behavioral finance theorists also posit that irrational trades tend to be correlated. So efficient markets would argue that, some investors are probably irrational, but, they cancel each other out. This guy thinks this stock is worth more. This guy thinks it's worth less. And in the markets, it all is a wash. Well, what we actually find is that people tend to behave similarly. And so you get these waves, you get these market surges, and you get these market crashes. And so that's what we mean, is that irrational trades tend to correlate. And you can't count on arbitrage to bring prices down. What is arbitrage, you ask? Okay, so arbitrage is basically a fancy word that means that big market players are going to act to balance markets, like hedge funds, for example. Well, how did that turn out with the hedge funds that were betting against GameStop in 2021? Ow. So, this is going to happen. And by the way, you know, institutional traders tend to just go along with the flow. They don't bet against the market. Usually, there's a few outliers, there's a few that do, but by and large, they go with the market. Hedge funds were net positive owners of dot-com stocks in the dot-com bubble and net sellers in the subsequent crash. No one's getting it right. Okay. And that's why this matters for you, right? First of all, just to become a better investor, this is important to know about. But more importantly, I am passionate about this because you are a target. Yes, you, my friend, if you're listening to this show and you're a law firm owner, you're a target. You're a high income earner. And high income earners are high stakes. They're targets. You're a target of bad actors. And let me tell you, there are a lot of bad actors today. People that are making up all kinds of things. You see it in social media. You see it all over the place. You see people being conned into financial schemes and abuses and, getting swayed by people who think they can time the market or pick stocks. And if you're making a high income, you are a target. And I got news for you. Even the professionals are prone to these biases. That's right. Your financial advisor is prone to these human behavioral biases just like you. And by the way, these same biases show up in how you run a law firm. So it just so happens that becoming a better investor will make you a better business leader. And that's what's probably forefront on your mind. Let me give you a little story. There's a guy named Bill Wang. Maybe you remember him. 2021, not too long ago. He was the founder of a fund called Archegos Capital. He built a fortune of $20 billion using extreme leverage. You may remember the story. It was splashed across the headlines. He used borrowed money. Okay, margin, leverage. This is how most of these stories end badly. Okay. He used borrowed money to make concentrated bets on a handful of stocks. Okay, right there. Hold the phone. You're doing all the wrong things. Concentrated stocks, a handful. You're not diversified. You're betting on margin. We know how this story is going to end. Well, at its peak, he had more than $100 billion in market position. So this worked really well. He was good. He was great. He was doing really, really well. And as we have mentioned on this show before, there are people who do time the market and they do really well. The problem is they can't do it consistently. And the number of those who do is what we would expect, right? The performance of traders follows a bell curve distribution, which is the same exact pattern that we would expect from random chance. And with random chance, as you know, in a bell curve distribution, most of the outcomes fall in the middle, and you have some way on the negative side, and you have some way on the positive side, and those are called outliers, but they do happen. Now, to take an outlier and base your entire investment thesis on an outlier is a big logical fallacy. That's a big mistake. Anyway, stocks dipped, margin calls cascaded, his fortune vanished, get this, in 48 hours. Vanished. Gone. All the billions of dollars, gone. And top it off, he was arrested and charged with fraud. So, this is important. Okay, what are the behavioral biases? Okay, I'm going to give them to you. There are five behavioral biases that we are prone to as human beings, that you are prone to. And here's the kicker. You don't even realize it. You don't even know it. And it's like, I can't think of a great example, but it's like, you have a problem and you don't even know it, right? It's like trying to convince an alcoholic that he's an alcoholic. We have this problem and we don't even realize it and we don't want to even admit it. The first one is overconfidence. Overconfidence is the tendency to think that we can beat everyone else, that we can do better than everyone else. okay, that we can do better than the crowd. And in markets, it's the tendency to think that we can outsmart the market. And by the way, guys, I got bad news for you. It's worse with men in general. In a study, economists examined individual accounts at a brokerage firm and found that the more individuals traded, generally, the worse they did. Wow. The worse they did, because here's what happens. The more overconfident you are, the more you tend to trade. And this is another thing they found. Men tend to trade more than women. So women tend to trade less. They tend to be less overconfident when it comes to the markets. They tend to have better investment returns. So let your wife do the investing, okay? And then another study of Robinhood clients found that the most frequently bought stocks had negative absolute and relative returns. They lost an average of 5% over the subsequent month relative to the market. So, does it pay to buy the stocks that everybody's talking about? Generally, no. A related bias, and this isn't another one, but a related concept is this idea of hindsight bias. And that is that everything looks better in hindsight, right? And the reason for that is our brains are biased to remember good outcomes and not remember bad ones, or rationalize away bad ones. And so we tend to remember the good stocks that we picked. Oh, I made a killing in this one. But we tend to forget the ones that were losers, or we tend to rationalize them away. Oh, that was just because blah, 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 blah. Well, how does this connect to you as a law firm owner? Well, overconfidence can rear its ugly head as a business owner as well. As business owners, we tend to be very overconfident, and we tend to think we can outwork, outsmart, outthink anyone and any problem. It leads us to put more on our plates than we should. It leads to a failure to delegate. It leads to burnout and stress. And it leads to taking risks that we maybe shouldn't take, right? It leads to this growth epidemic. I'm going to use those words, because everybody wants to have a $10 million business these days. And, the reality is, only a handful of us are going to get there, right? Because there's a combination of things, some that are in your control and some that are not. There's a good deal of luck, that comes into creating a highly successful business. Okay, that's number one, overconfidence. And number two, I'm glad we talked about the connection to law firm ownership, because this leads right into it. And it is the illusion of control. Very related to overconfidence is the illusion of control. Number two, the illusion of control it's a bias of judgment where investors are convinced that they can control outcomes. As human beings, we're often convinced that we can control things that are completely beyond our control, whether it's, crazy things like, completely unrelated events. Every time I get a cold, there's a rainstorm, or I don't know, things that could be completely crazy like that, or things that are not as crazy. But this is a real human tendency, and it's a little bit freaky. So I'm going to actually read you a little story, and this is going to blow your mind. Okay. Each year, and this is right from our book that we're reading, each year, a statistics professor begins her class by asking each student to write down the sequential outcome of a series of 100 imaginary coin tosses. One student, however, is chosen to flip a real coin and chart the outcome. The professor then leaves the room and returns in 15 minutes with the outcomes waiting for her on her desk. She tells the class that she will identify the real coin toss out of the 30 submitted with just one guess. With great persistence, she amazes the class by getting it correct. How does she perform this seemingly magical act? She knows that the report with the longest consecutive streak of heads or tails is likely to be the result of the real flip. The reason is that when presented with a question like, which of the following sequences is more likely to occur, heads, 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 tails, 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 or heads, tails, heads, tails, heads, tails, despite the fact that statistics show both sequences are equally likely to occur, The majority of people select the latter, more random outcome. They thus tend to write imaginary sequences that look much more like heads, heads, tails, tails, heads, tails, heads, tails, than heads, 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 tails, 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 tails. This goes to what we think randomness should look like, right? And we talked about this. When we talked about technical analysis, right? Our tendency, our proclivity to find patterns where none exist. And yes, randomness can produce patterns, and it can look like it's predictable when it's actually not. And those streaks happen in markets, a series of streaks of positive movements, and we'll think, oh, the market's on a trend. There's an uptrend. Well, here's the thing. Streaks and trends eventually end. And we have a concept called reversion to the mean. Psychologists have long identified the tendency for individuals to be fooled by the illusion of control. I'm going to read you one other study here. And that is this. In one study, subjects were seated in front of a computer screen divided by a horizontal line, with a ball fluctuating randomly between two halves. The people were given a device to press to move the ball upward, but they were warned that random shocks would also influence the ball, so they did not have complete control. Subjects were then asked to play a game with the object of keeping the ball in the upper half of the screen as long as possible. In one set of experiments, the device was not even attached, so the players had absolutely no control over the movements of the ball. Nevertheless, when subjects were questioned after a period of playing the game, they were convinced that they had a good deal of control over the movement of the ball. I love that. It's so mysterious, right? The illusion of control. Boy, our minds do play tricks on us. And how does this connect to you as a law firm owner? Well, we often have this illusion of control in our business. And it leads to the same things, burnout and stress, because we think we're responsible for everything. And you know what? A lot of success in business is pure luck. Being in the right place at the right time, when preparation meets opportunity. We tend to think if we just work harder, we can control the outcome. But we need to respect luck and give luck the time it needs to operate in our lives. Put yourself out there and let the opportunities come to you. It's less about controlling the outcome and it's about doing the activities that will generate success. Okay, bias number 3 is herding. You may have heard of herding like a herd of cattle, right? The wisdom of the crowd. The wisdom of the crowd is great in creating an efficient market, but the wisdom of the crowd often goes off the rails, too high up or too far down. Generally, it works, but sometimes it can go way off. And an even further aspect of this is groupthink. So groupthink takes herding to another level, but groupthink is a great example of herding. In groupthink, members of a group reinforce each other into believing some incorrect point of view. And there are so many studies that have shown this. Okay, let me just read you one here. It's so fascinating. Okay, let's see. Here it is. The lines. Okay. Sociologist named Solomon Asch was one of the first to study how group behavior may lead to incorrect decision-making. During the 1950s, Asch conducted a famous lab experiment. A group of participants was asked to answer a simple question that any child could answer correctly. The subjects were shown 2 cards with vertical lines, such as the cards shown below. The card on the left showed 1. The subjects were asked which line on the card on the right was the same length. 7 subjects participated. But Asch added a diabolical twist to the experiment. In some of the experiments, he recruited 6 of the 7 participants to deliberately give the wrong answer, and to do so before the 7th participant had a chance to express an opinion. The results were astonishing. The 7th participant would often give the incorrect answer. And he goes on to say, it's not only about that, the social pressure, but what they did is they looked at the brain while this was happening. What they found is that the area of the brain related to spatial awareness was what was being triggered. And so what this means is that not only can peer pressure affect our decisions and herd behavior affect our decisions, it can also affect our perception of reality. So it's very important to stay grounded. Don't do something else just because everyone else is doing it. And there's so many examples of this in business, copying someone else's marketing, fads, etc. Build on what works for you and use data to support it. The fourth bias is loss aversion. Loss aversion means that losses hurt more than gains. Well, duh, but in magnitude. So they've actually quantified this. The pain of a loss is 2 times more than a similar gain is pleasurable, right? So a 1% loss, the pain from that, the emotional pain from that, is far more than a 1% gain is pleasurable. The magnitude of the feeling. The loss feels stronger than the gain. Now, what this leads to in investments is we hold on to investments that are bad investments, hoping they'll come back. Boy, I bet you have some examples of this in your law practice. Hanging on to bad clients, hanging on to poor performing team members, hanging on to that hanging on to that SEO company that's not delivering good leads. Yeah. Ineffective strategies. How often do we hang on because of our loss aversion? Because cutting it loose would mean to admit a loss. If I just hang on a little bit longer, this is going to turn into a great win for me. And maybe it won't. Okay, the last one is pride and regret. Pride and regret affect our decision-making very strongly. We don't like to admit defeat. We're hesitant to sell losers, thinking they'll come back, or we'll regret it if we miss out. Very similar to loss aversion. We don't want to admit when something isn't working. Friend, what in your law practice, in your business isn't working? As we go into the end of the year here, what are you doing in your business that's just not working, that's not serving you? That's a great question to ask. Cut it loose. Let's go deeper. Let's go back through these and let's talk about how you can be a great, highly successful investor by avoiding these psychological biases. How do you avoid herd behavior? Have a disciplined strategy and stick to it. Fund inflows are highest at their peaks and fund outflows are highest at their bottoms. The crowd is wrong, my friend. But it's impossible to know in the moment whether how wrong the crowd is or if the crowd is wrong. But the crowd is often wrong. Number 2, avoid overtrading. Stop making changes. Stop trading in your account. A better strategy would be to buy and hold. Buy and hold. Hodl. If you do trade, okay, sell the losers, not the winners. Cut your losses and let your winners run, as the old adage says. Because those winners can run for a long time and the losers can stay losers for a long time. And the best winner, my friend, is the S&P 500. A nice, largely diversified strategy. They'll get all 500 of the largest companies all in one shot. And lastly, avoid investor tricks. Here's a few investor tricks. IPOs. You know the only one who benefits from IPOs? The investment bank. And the original shareholders, probably. Numerous studies, study upon study upon study, has shown that in general, IPOs lose money during the first few years. They're not successful investments. Now, sure, maybe they are unicorns. Maybe they go on to become unicorns. Google was once an IPO, but Google is one of thousands, right? So take it with a grain of salt. Your odds of picking the next Google IPO are very low, friend. Number 2, stay cool to hot tips. I know your aunt or your uncle, they've got a hot stock that they want to tell you all about. These are overwhelmingly likely to be the worst investments of your life. And don't take hot stock tips from financial advisors either. While we're at it, they don't know jack shit either. And I can say that confidently. I can say that confidently on the back of science, on the back of study after study after study that demonstrates and proves this. If you have a portfolio that is stock based and it's not well diversified, and you're working with someone who's picking stocks for you, this may work for a time, but there will come a time when it doesn't work. And more than likely, it hasn't been. Number three, don't trust foolproof schemes. Oh my God, there are so many nowadays. Open up social media and everybody's a freaking life insurance salesman trying to pitch indexed universal life or cash value life, or everybody's a day trader doing a TikTok live about how to spot wedges and heads and shoulders and blah, 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 blah. Okay. If 15-year-old Johnny is such a stock whiz, why is Wall Street not picking him up? Why is he not running the biggest hedge fund on Wall Street? I'm just asking for a friend. And more importantly, if something's too good to be true, it probably is. You know, if some guy's telling you that he can outperform the market, don't believe him. Maybe he will. Maybe he'll be one of the 1% that do. But there's a 99% probability that he won't, and that you will lose money or you won't reap from the generous rewards that the market provides. And worse than that is it might be a scheme. Bernie Madoff was the largest Ponzi scheme ever. He offered safe returns in the neighborhood of 10 to 12%, nothing outrageous. And don't count on regulators to help you, because even the SEC didn't act when it was warned. It took a long time. You know, I've been there, my friend. I've been there. I've done it. I've made the mistakes. So I'm here to tell you not to make the mistakes. I've tried to time the market. I have tried out countless market timing strategies, newsletters, systems. I've tried them. I've tried almost all of them. I can probably, well, unlikely. There are so many, but I've tried a lot. And let me tell you, they don't work. They just don't work. They sometimes work once in a while, but most of the time they don't. And most of the time you'll be sorely disappointed. You might get that 1 year where you beat the S&P 500. But if you significantly outperform the other 9 years, is it worth it? Heck to the no. I don't have 20 years to sit around and wait for some investment strategy to finally start working. I need the market's returns now. That's the tragic result, is missing out on the generous gains of the stock market, and you can't go back in time. I want to save you from that, friend. Here at the Lawyer Millionaire, we help law firm owners like you become better investors and better business leaders as well. I want to help you too. We're your one-stop shop for all your business and financial planning needs, and part of that is managing your investments. Our approach is based on the timeless, proven strategies of passive, long-term index investing, of modern portfolio theory, and efficient markets. Our approach is simple, straightforward, and low cost, because that is what is best. And that's only part of what we do. When you work with us, you get an entire team. You get an entire financial and business team under one roof. We're your one-stop shop. We're your family office. You get the whole team. You get the squad. You get a financial planner. You get an investment advisor. You get a CPA and bookkeeper. And you get a business advisor. All on one team. And what's beautiful about that is no more juggling between different advisors, no more going back and forth and everybody's giving you a different answer. We're all communicating together, working on your behalf, saving you a ton of time and money. If this episode made you realize that you might be leaving money on the table, or worse, sabotaging your results when it comes to your investments, or even worse than that, working with an advisor who is sabotaging your results, it's time for us to talk. Don't let another year slip by. This is the perfect time to book some time. Book a call with me today, and let's put the right strategies in place for you to grow your wealth and to grow your business. And if you want to connect with other law firm owners doing just that, join our Lawyer Millionaire community. The link, as always, is in the show notes. Well, that's a wrap, my friend. And remember, the ultimate form of wealth is freedom. I'm your host, Darren Wurz. This is the Lawyer Millionaire. I'll see you next time.